The global solar industry is entering a period of subtle but important change. Rising costs of raw materials, shifting supply chains, and evolving energy policies are prompting manufacturers to rethink the metals they use. Silver, long a critical component of solar panels due to its superior conductivity and efficiency, is now competing with alternatives like copper in certain applications. While this may sound dramatic, the transition is gradual and reflects industrial optimization rather than abandonment. Before we begin, subscribe to the Monetary Silver Brief for clear, fact-based insights into metals, industrial demand, and market trends. This channel focuses on analysis and verified data. No hype, no speculation. Silver's role in photovoltaics is unique. Its conductive properties allow solar panels to operate at high efficiency over decades. Substituting with copper is possible, but only at the cost of reduced performance or durability in some cases. For solar manufacturers, the decision to partially integrate copper is a balancing act, reducing costs without compromising product quality. This strategic adjustment is reflected in recent market discussions and indirectly in silver prices hovering around $77. From a financial perspective, silver's price near this level has multiple implications. Short-term movements are often amplified by leveraged trading on futures markets, but these swings do not necessarily reflect long-term industrial fundamentals. Margin adjustments, institutional positioning, and macroeconomic factors all contribute to volatility. Investors and observers must differentiate between mechanical price movements and genuine demand signals. Industrial demand for silver remains robust. Electronics, renewable energy, and medical applications continue to require the metal, independent of short-term fluctuations. What is shifting is the way industries manage costs. Partial substitution with copper allows for controlled exposure to rising prices without halting production. Over time, efficiency gains and technological innovation often offset such adjustments, meaning silver consumption remains substantial. Understanding this dynamic also requires looking at supply chains. Global silver production has geographic and logistical constraints. Mines operate at fixed capacity, and refiners manage output according to contracts with industrial buyers. When demand signals adjust, for instance, due to partial copper integration, physical flows can temporarily lag or accelerate. Market participants watch these flows closely, as they provide insight into real consumption versus speculative positioning. Another factor is investor behavior. Price levels near $77 attract attention from traders, funds, and banks. Some may interpret rising prices as a bullish signal, while others see it as an opportunity to reduce exposure. The interplay between industrial demand and financial market positioning creates moments of heightened volatility, but it also highlights the resilience of silver's dual role as both a commodity and a monetary-sensitive asset. Solar manufacturers' gradual integration of copper should not be misunderstood as a loss of confidence in silver. Rather, it is a reflection of operational pragmatism. By adjusting the material mix, companies maintain efficiency, cost-effectiveness, and product quality. Silver continues to underpin the majority of production, particularly in high-performance panels where conductivity and longevity are critical. Macroeconomic trends further shape this environment. Global energy policies, inflation expectations, currency trends, and interest rate dynamics all influence investor perception of silver. These factors interact with industrial signals, producing price patterns that may appear extreme in the short term but are rational when examined through the lens of structure and long-term demand. The next key observation period, particularly over the coming 2 weeks, offers insight into how the market absorbs these industrial adjustments. Analysts and investors are closely monitoring volume patterns, open interest, and inventory reports. These signals help differentiate mechanical price reactions from genuine shifts in consumption. In conclusion, silver near $77 is not a sign of collapse or abandonment. It represents a dynamic equilibrium where industrial demand, financial markets, and technological adaptation converge. The solar industry's partial shift to copper is a strategic response to costs, not a rejection of silver. Understanding this balance is essential for anyone seeking clarity amid short-term price volatility. As the solar industry adapts to rising input costs and evolving supply chains, the story of silver becomes more nuanced. The partial integration of copper into solar panels does not represent a reduction in silver's overall importance. Instead, it highlights how industries manage cost efficiency while maintaining technological standards. Understanding this distinction is crucial for interpreting price behavior and market signals. Silver remains indispensable in high-efficiency photovoltaic panels. Its conductivity and durability are unmatched, making it critical for long-term performance. Copper can substitute in specific applications, but it often requires compromises in efficiency or lifespan. Manufacturers are therefore selective about where substitution occurs, typically reserving copper for lower-tier applications or areas where performance is less sensitive. This selective approach ensures that silver consumption remains meaningful even amid adjustments. From a financial perspective, silver's price near $77 reflects both industrial demand and broader market positioning. Futures markets, leverage trading, and margin adjustments amplify short-term swings. Traders often react to volatility rather than fundamentals, creating rapid but temporary price changes. Observing volume trends and open interest during these fluctuations helps distinguish between speculative movements and industrial-driven demand. Supply chain logistics also play a significant role. Silver production is geographically concentrated and mining output follows long-term cycles. Refiners distribute metals according to contractual agreements with industrial buyers, meaning physical demand may not immediately correlate with paper market volatility. Tracking these flows provides insight into actual consumption patterns, particularly in sectors like solar manufacturing, electronics, and medical technology. Institutional behavior further shapes the narrative. Banks, funds, and professional investors monitor both industrial and speculative dynamics when positioning in silver. Reduced trading activity after margin adjustments does not indicate abandonment. It reflects risk management, compliance with capital rules, and strategic repositioning. These decisions occur over weeks, often lagging short-term market reactions, but providing a clearer picture of sentiment and demand alignment. Technological innovation also influences silver consumption. Advances in panel design, production efficiency, and material science can reduce per-unit silver requirements without affecting performance. These improvements partially explain why the solar industry can integrate copper selectively without reducing total output or compromising product quality. Over time, this creates a balanced demand environment that supports steady consumption and price stability. Macro factors such as global energy policy, currency trends, and interest rate expectations intersect with industrial dynamics. Investors consider these when interpreting silver's monetary-sensitive role. For example, inflationary expectations or currency volatility often drive investor interest in silver as a hedge. These monetary influences, combined with industrial signals, produce price movements that may appear dramatic but are structured and logical upon closer inspection. Market participants are also watching short-term indicators like inventory levels, delivery volumes, and producer behavior. These signals reveal how manufacturers respond to current pricing, how quickly they adjust material usage, and whether demand remains robust. A steady pattern of physical demand, even during price swings, confirms that silver retains structural importance despite temporary market noise. Behavioral factors among traders can exaggerate volatility. Retail and speculative participants often react emotionally to headlines, while institutions and industrial buyers operate with discipline. Recognizing this distinction is key. Price spikes or dips do not necessarily reflect long-term changes in demand, but rather shifts in market participation and perception. In essence, the industrial demand story for silver is one of strategic adaptation. The solar industry's selective use of copper allows manufacturers to maintain cost control while ensuring panel performance. Silver remains central to high-efficiency applications, while short-term price fluctuations provide opportunities for observation, not panic. In conclusion, industrial substitution and strategic cost management highlight silver's resilience. Markets are currently processing this transition, balancing short-term volatility with structural demand. Observers who focus on these underlying dynamics gain a clearer understanding of why silver remains relevant and why maintaining perspective is critical during periods of adjustment. As the solar industry gradually integrates copper into certain applications, the financial markets continue to watch silver closely. Prices near $77 reflect a combination of industrial demand, speculative positioning, and macroeconomic influences. Understanding how these factors interact is essential for anyone observing silver's behavior over the next weeks. One of the most significant influences on silver's price is institutional positioning. Banks, funds, and professional traders manage exposure through futures, options, and over-the-counter contracts. Following recent volatility, many institutions have recalibrated positions rather than exiting entirely. Reduced visible activity does not imply declining confidence. It reflects risk management, adherence to capital requirements, and strategic repositioning. Over the coming days, patterns in open interest, volume, and delivery activity will reveal how institutional participants are adjusting. Margin requirements and leverage constraints amplify price movements in the short term. When margins increase, leverage traders reduce exposure or temporarily step back. These adjustments create mechanical volatility that often attracts attention. However, experienced investors recognize that such fluctuations do not necessarily correlate with industrial fundamentals. Instead, they provide insight into how market participants are responding to structural changes. Physical demand continues to anchor the market. Solar panel manufacturers, electronics producers, and medical equipment suppliers maintain relatively steady silver usage. While temporary substitution with copper affects marginal volumes, the core industrial demand remains robust. Observing these physical flows alongside paper market activity is critical to understanding true market health. Macroeconomic factors also influence silver positioning. Interest rate expectations, currency movements, and global liquidity shape investor perception. For example, uncertainty in major currencies can drive hedging demand in silver. Similarly, inflationary signals often increase its attractiveness as a diversification asset. These forces interact with industrial trends, producing price behavior that may seem erratic but follows a logical pattern once examined structurally. Behavioral aspects further explain short-term volatility. Retail traders often react to headlines or price swings, amplifying movements. Institutions, by contrast, tend to act deliberately, considering multiple time horizons and risk metrics. This divergence between short-term sentiment and long-term strategy creates the volatility and consolidation patterns we currently observe. Technological advances in solar production also influence silver demand. Improved efficiency reduces per-panel silver usage, allowing partial copper substitution without significantly affecting output. Over time, these innovations smooth industrial consumption, creating a more predictable demand base. The combination of technological adaptation and market positioning creates a layered environment that markets interpret gradually. Indicators such as volume trends, open interest changes, and inventory flows provide early signals of market balance. Gradual increases in volume after a quiet period suggest institutional re-engagement and normalization. Steady physical flows reinforce confidence that industrial demand remains intact, even as price reacts to paper market mechanics. Price near $77 serves as a testing point for market participants. Traders, investors, and industrial buyers are all evaluating whether current conditions align with long-term expectations. This interplay between industrial strategy, speculative positioning, and macro factors makes the next observation period particularly revealing. The financial market dimension of silver complements industrial adjustments. Margin-driven volatility, institutional repositioning, macro influences, and technological adaptation collectively shape pricing behavior. Observers who focus on structure rather than headlines gain the clearest understanding of why silver remains critical even as temporary adjustments occur. As the short-term adjustments in both the solar industry and financial markets play out, the broader perspective on silver becomes clearer. While headlines may focus on price swings near $77 or the integration of copper into solar panels, the underlying fundamentals of silver remain robust. Understanding these dynamics requires looking at industrial demand, technological trends, macroeconomic factors, and market positioning collectively rather than individually. Silver's dual role as an industrial metal and a monetary-sensitive asset provides inherent resilience. Even as some solar manufacturers adopt copper selectively, silver continues to dominate high-efficiency applications. Its superior conductivity, durability, and long-term reliability make it irreplaceable in critical photovoltaic components. Partial substitution does not equate to abandonment. It is an operational adjustment aimed at cost efficiency without compromising performance. Over time, these incremental changes often stabilize consumption rather than reduce it dramatically. From a market perspective, volatility near $77 reflects a combination of factors. Margin adjustments, leverage positions, and institutional repositioning create short-term fluctuations. These movements may appear exaggerated to casual observers, but are largely structural in nature. Experienced market participants monitor volume, open interest, and delivery data to distinguish temporary disruptions from meaningful demand changes. Patterns of gradual stabilization often indicate that the market is absorbing these adjustments and preparing for the next phase. Physical demand continues to anchor silver's value. Solar panels, electronics, medical devices, and industrial applications consume a steady supply regardless of short-term futures market volatility. Even with minor substitution, overall demand remains strong. Observing inventory flows, delivery reports, and production schedules can provide insight into true industrial requirements. This is critical for assessing whether price behavior aligns with structural fundamentals. Macroeconomic trends also shape silver's outlook. Currency fluctuations, interest rate expectations, and global liquidity conditions influence investor sentiment and positioning. Inflationary pressures, monetary policy shifts, and geopolitical developments can affect silver's appeal as a hedge or diversification tool. Unlike short-term price spikes, these factors evolve gradually, reinforcing silver's role beyond immediate market noise. Institutional behavior is another essential element to watch. Banks, funds, and professional traders manage exposure according to capital requirements, risk tolerance, and strategic objectives. Reduced activity in futures markets does not indicate a lack of confidence but reflects disciplined risk management. Over the coming weeks, subtle changes in open interest, volume, and positioning will reveal how institutions are balancing exposure to both industrial demand and financial market trends. Technological innovation further supports silver's resilience. Improvements in production efficiency, material science, and panel design allow manufacturers to reduce per-unit silver usage without compromising output. This creates a more predictable demand base, allowing markets to absorb short-term volatility while maintaining long-term industrial stability. The interplay of innovation, selective substitution, and steady consumption underpins the metal's ongoing relevance. Behavioral dynamics among traders also contribute to market behavior. Retail participants often react quickly to headlines, amplifying volatility, while institutional investors act deliberately, considering long-term trends and structural signals. This divergence between short-term sentiment and fundamental strategy creates periods of fluctuation that reward observation over reaction. Looking ahead, key signals to monitor include price acceptance and stability during low news periods, gradual return of volume and liquidity, open interest adjustments reflecting strategic positioning, steady physical demand in industrial applications, macro trends affecting monetary and diversification demand. Taken together, these indicators provide a comprehensive view of how silver is adapting to current market and industrial changes. Temporary volatility and partial copper integration should be understood in the context of structural strength and long-term utility. In conclusion, silver near $77 is not a signal of weakness. It reflects an equilibrium between industrial strategy, market positioning, and macroeconomic factors. The solar industry's selective material adjustments, coupled with steady demand and technological improvements, maintain silver's essential role. Observers who focus on structure, trends, and fundamentals rather than short-term fluctuations gain the clearest understanding of why silver remains relevant, resilient, and closely watched in both industrial and financial markets.